I messed up, and not just a little bit. I'm talking about a portfolio-crushing mistake that nearly wiped out years of progress. On paper, everything looked perfect. I was following the rules, diversifying, playing it safe. But when I looked under the hood of what's actually happening in 2026, I realized I was positioned for a world that no longer exists. This realization forced me to make my biggest financial pivot since the 2020 crash. Today, I'm pulling back the curtain. I'm showing you every single dollar, every investment, and the massive opportunities that most investors are completely blind to. Because the truth is, the way you invest over the next 12 months will determine if you build wealth or just pay for everyone else's. Wait until you see why I'm selling off assets I swore I'd hold forever. But before we dive into the data, if you appreciate this level of transparency, where I show you the wins and the ugly losses, do me a quick favor, smash that like button and subscribe. It genuinely helps the channel survive the algorithm. Done. Let's get into the first big shift, the stock market. For a decade, my strategy was simple. Dollar cost average into the S&P 500 every single day. Rain or shine, it worked. In fact, it outperformed almost every other asset class. But here's where the mistake comes in. With all the headlines screaming about stretched valuations and economic uncertainty in 2026, my gut told me to hoard cash. I was waiting for the big dip, and that was my error. Looking back at 10 years of data, every time I sat on the sidelines waiting for a crash, I lost more money in missed gains than I would have lost in a correction. Time in the market beats timing the market, always. So instead of building a crash fund, I'm actually investing heavier now. When sentiment is at its worst, that's your signal. While everyone else is paralyzed by fear, I'm funneling more of my monthly income into the S&P 500. I'm treating every minor red day as a flash sale. If the sky is falling, I'm buying the stars. But I'm not just betting on America. There's a secret weapon in my portfolio that's currently outperforming everything. Let's talk about the part of my portfolio that most people hate, international diversification. Right now, about 28% of my account is in non-US stocks. Historically, this has been the boring part of the portfolio that underperforms the US. But look at the 2025 to 2026 data. While the S&P 500 is roughly breaking even this year, my international holdings are up 38% year over year. Why? Because the US market is highly priced for perfection. Meanwhile, emerging markets and established international economies have massive room for catch-up growth. I'm treating this as my hedge. If the US dollar fluctuates or the domestic tech bubble cools down, these international assets smooth out the ride. It's about asymmetric upside. I'm not going all in, but I'm no longer ignoring the rest of the world. If you only invest in your own backyard, you're missing half the party. Now for the most controversial move, I am selling everything. Every rental property I own except the house I live in. If you told me 5 years ago I'd be exiting real estate, I would have laughed. But the reality of being a small landlord in California in 2026 has become a nightmare. The mix of regulation and a literal villainization of property owners has made the business impossible. Insurance costs doubled, repair costs tripled. But the breaking point, the legal risk. I now have to pay a $400 an hour lawyer just to send a text to a tenant. One wrong word, one missing disclosure, lawsuit. I've seen cases where tenants stop paying and the legal mediation forces the landlord to pay the tenant to leave. It's insane. Back in 2012, an eviction cost me $1,500. Today, it could cost $60,000 and 2 years of my life. I'm taking my profits while values are high, and moving that money into assets that don't call me at 2 a.m. with a broken pipe or a legal summons. This brings me to a psychological trap I fell into, holding too much cash. Right now, 25% of my portfolio is in cash and treasuries. I realized I had shifted from playing to win to playing not to lose. When you've spent years building wealth, you become terrified of losing it. But in a high inflation environment, safe is the new risky. However, you still need your cash to work for you. One of the smartest moves right now is optimizing every penny. Most big banks pay you basically 0% interest. That's why I use SoFi, our sponsor for today. They offer up to 4.60% APY on savings, which is miles ahead of the national average. Plus, you can get a bonus of up to $400. Whether it's SoFi or a treasury bill, your waiting room money needs to be earning. But I've realized my 25% cash position was too high. I was playing scared. So I'm rotating that money back into the market. Because the biggest risk isn't a market crash. It's reaching 60 and realizing your money didn't grow enough to keep up with the world. Let's talk about Bitcoin. In 2026, it's no longer just a meme or a gamble. It has become a portfolio efficiency tool. I've been DCAing into a Bitcoin ETF because the institutional adoption is now undeniable. My thesis is simple: asymmetric risk. I'm investing an amount I'm okay losing, but if Bitcoin continues its trajectory as digital gold, the upside is life-changing for generations. With national debts hitting record highs and global deficits spiraling, Bitcoin offers a hedge that isn't tied to a government's printing press. Interestingly, Bitcoin's volatility is actually decreasing as the big money enters. I'm buying more now when sentiment is quiet, because the best time to buy is when people say, Bitcoin is dead. It's died 1,000 times and come back stronger every single time. It's only a small slice of my pie, maybe 3 to 5%, but it's the slice that could potentially double the entire pie's value. Not all investments have to be digital or on a spreadsheet. Some you can actually drive. My 2005 Ford GT has been one of my best performing assets, up 65% since I bought it. It's like an index fund you can take to 200 mph. But I also have to be honest about the losses. My Tesla Roadster, down 30%. People are moving away from the Elon brand and EV values have stabilized. It's a reminder that even with tangible assets, you can get it wrong. I've also started collecting early Disney art sketches from the original animators. Why? Because these are culturally significant, finite assets. There will never be more 1950s hand-drawn sketches. Whether it's watches, cars, or art, these lifestyle investments only work if you understand the niche. If they go up, great. If not, you still have a beautiful piece of history. The biggest lesson I've learned in 2026: don't undervalue simplicity. I've invested in private equity startups that looked amazing on paper, but I'm locked in for years. I can't sell, I'm getting diluted, and I have zero liquidity. It's a headache I don't need. The best portfolio isn't the most complex one. It's the one that lets you sleep at night. For me, that means more liquidity, fewer moving parts, and total transparency with myself. I'm shifting back to the basics: stocks, international, a bit of crypto, and a lot less legal drama. If you take one thing away from this video, run your own numbers. Don't let your portfolio run on autopilot for 10 years without checking the weather. Change is okay. Selling what used to work is okay. Just stay honest with yourself. If you found this breakdown helpful, share it with one friend who needs to hear this. Thanks for watching, and I'll see you in the next one.